Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Paul and I can't remember a guest a half hour ago. To remember a guest 2 days ago is unthinkable. It's a blur what we do. We have a great team, including Cy Benson, who keep us going forward. I remember exactly, Paul, what Nancy Lazar said 90 days ago or 100 days ago. Folks, this was the single most important piece of American wisdom from Nancy Lazar, and she joins us again here this morning with too short a visit. She's with Piper Sandler. You said it's a baloney reality for America. We're investing in government and all these derivative jobs, and we're not investing in the private sector to create a backbone of job formation and prosperity in America. Has that been amended in all the theatrics of the last 3 months?
Well, the big, beautiful bill did indeed incentivize companies to invest more in the United States. And that is one of the positives you can say about the current legislation. Companies can now fully expense their capital spending.
Exactly. It sounds like LBJ 101.
Well, I'm not sure it's LBJ 101. I might go to Ronald Reagan 101. He was really the first president to articulate the importance of investing in the economy through his accelerated depreciation tax legislation. So no, I wouldn't go back to the 60s. That's actually an inflationary period. I would certainly hope we're not going back there.
Seriously, just put me in the timeout, this Lazar timeout chair. Sure. Paul, why don't you pick it up here?
So there are some positive pro-growth parts of the legislation, which the market had been anticipating when this president was elected. On the flip side, we've got the uncertainty of tariffs. A, the cost of tariffs, and who's going to bear that, and B, just kind of the uncertainty that brings into corporate America. How do you balance those two?
Well, I think near term, obviously, tariffs are going to be the driving force, creating the soft patch, as we're calling it, weaker economic activity. They are near term a negative. We're going to see it in 2Q growth, even though headline GDP will be 2 to 3% in the second quarter. Underneath the hood, if you look at private domestic demand, it's going to be closer to 0.5%. The swing is due to trade, right? Trade was a big drag on 1Q. It's going to be an incremental support for 2Q. So right now, private demand is shifting down to about 0.5, 2Q probably also into 3Q. So near term, the tariffs are indeed the driving force in the economy. But as we go into 26, I think these other incentives to invest in the United States, capital spending, supporting private sector in investment, and in turn, eventually jobs are going to be more important. And the market, quite frankly, may be looking through that. Except tariffs, they're here to stay. We've built them into our forecast. Near term, they're going to show up in the inflation data more clearly as we go into 3Q. You can already see it in the data. We highlight that this morning. 3Q will be a little bit more evident with higher prices. Both businesses and consumers are paying these higher prices.
Right.
And that's giving us the soft.
Are we going to have a David Stockman moment in later Reagan where we go, oops, there went the fiscal budget?
I think we may already be in that environment right now. I actually, when I look at the government spending data, I can see some incremental restraint. I think I get booed when I talk about that, but you can see it if you look very closely at the monthly Treasury statement. The federal outlay data are starting to stall out. You're hearing it from companies, software, defense, consultants. You are hearing companies say the government's being a little bit more stringy. You're seeing it in the job data. Federal employment has declined for the past 5 months. It's going to, given what happened yesterday, it's likely to accelerate. Federal employment is likely to continue to decline. So I'm seeing government spending being chipped away. I might almost like a David Stockman moment, which is like, wake up and smell the coffee. The deficit is way too big. Government spending is way too big. I think some people within the administration understand that, and you are starting to see some incremental restraint, and not this year, but maybe next year the deficit can come in a little bit better than expected.
But the deficit, just one big beautiful bill, it adds to deficits, debt, and billions of dollars. The market doesn't care.
Well, again, it does incrementally add to the deficit. It keeps it at about 6.5% of GDP. It's not going to be bigger than it otherwise would have been. Again, you're just extending these tax cuts. I don't disagree with you. The market doesn't care, and one of the reasons the market's looking through this is because, as I've said before to you all, capital spending is an ugly duckling of economic data, and this bill reinforces the need to invest in this country.
Right. Let's go to first principles here, because folks, Nancy Lazar with us, with Piper Sandler. Thrilled she could be with us. Absolutely iconic on a view of the American economy. Okay, so consumption is 69, 70% of GDP. How much is that private investment, that Lazar need? How is it 11?
No, it's 14. Capital spending is about 14% of GDP, so it is clearly less than the consumer. But again, it's therefore it is underappreciated as a driver. It's the multiplier effects from capital spending that are so important. If you go around the country and you look at states from Georgia to South Carolina to Indiana, where you've had very clear investment booms, those economies are doing well because of the multiplier. You create services associated with these factories.
Listen to you. Are we back to a 1950s, 1960s multiplier superiority of capital investment in manufacturing?
I think so. It's actually been unfolding for about 15 years. And so I think at the end of the day, yes.
Get one more in here, Paul.
Real quickly, how's the consumer out there?
We call it the new smarter consumer. The consumer right now is reacting to these higher tariffs. Real consumer spending is stalling out, from services to machine to hardware. You are seeing the consumer pull back. The only thing we're buying right now are clothes. I'm certainly helping to do that. But the consumer is reacting to the uncertainty, to the higher prices. But we don't think the consumer is going to push us into a recession. It takes a lot to push the consumer into negative territory. So stall speed, yes. Recession, no.
Nancy Lazar, thank you so much. Piper Sandler.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Right now for Global Wall Street, a treat, iconic Ian Lyngen at the Bank of Montreal, BMO Capital Markets. Ian, what happens to John Tucker, Paul Sweeney, and Tom Keene's world if I get a 525 or a 550 yield on the 30-year bond?
I think that we would see some excitement in the equity market. And by excitement, I mean to the downside. We've already tried to retest those levels in the past. And the reality is that risk assets can't handle it. We're not an economy made for 30-year bond yields that high.
So it seems like we're going to be getting tariffs here, Ian. That seems to be, and probably aggressively so. What does that mean for the bond market?
So I'll argue that to a large extent, tariffs are already priced in. We see it in 10-year break-evens. We see it in inflation futures. The reality is that we are looking for a summer of reflation. Certainly on the good side, I think the fascinating aspect is that we still haven't seen it materialize in the realized data yet. Now, next week we get CPI. There should be some signs of upward pressure, but the consensus is just 0.3, and that's relatively benign and good for the bond market overall.
So the 10-year Treasury, I mean, we're sitting here at, roughly 4.40%. Where do you think maybe we end the year on the 10-year U.S. Treasury?
Our forecast is that we end 2025 with 10-year yields at 385. Now, that might sound somewhat dramatic, but we were just at 418 at the beginning of July. So more than anything, it's going to be a range.
So describe the bond vigilantes. The important statement here from Mr. Lyngen, the jargon is the linkage here, folks, of the bond price movement, which changes the yield as we're buffeted in the economy and all. And Lyngen, are the bond vigilantes just so powerful the White House has to listen to Ed Yardeni and Ian Lyngen?
That's an interesting question. I think to some extent, the bond vigilantes had their day on the budget debate. And to some extent, we've heard from Besant that he is going to focus borrowing in the bills market, not further out the curve. So arguably, the bond vigilantes won this round.
I mean, we got to stop the show, folks. This is Ian knows how to press my buttons. Okay, Ian, cut to the chase. The head of the CEA, hugely criticized by the economic establishment, pushing against the giant Peter Fisher from years ago, says we're going to load the boat on short-term paper and change our duration, and maybe we're then going to go out and buy 20-year paper. Am I right, Paul? Sure. French perpetuity bonds and the rest. Ian, discuss this. Should we shift the distribution of our debt because Steve Mirren says we should?
Well, one thing that I'll note is that the rest of the world is already doing this. The UK is doing this. We've heard from Bank of Japan that they're willing to be responsive to how the market is pricing in their borrowing needs. And we even saw Yellen do that in 2023. And so the idea that Besant is taking advantage of the lower rates in the front end of the market is consistent with what the rest of the global sovereign debt market's doing.
Ian, I'm looking at the 2-10 spread here. I got my 2-year Treasury, let's call it 390. My 10-year at 440. So a 50 basis point steepening of the curve. Historically, has that been a normalized level, or how should we think about that?
So it's positive, it's upward sloping. That's consistent with what a curve normally is. I think the unique aspect of this is, all else being equal, we would expect the curve to be steeper, led by the front end of the market. But the Fed has so much uncertainty on whether or not they can start cutting again anytime soon, that's what's keeping the curve from being steeper in here, which has been to the surprise, I would say, to a lot of market participants at this cycle.
Ian Lyngen, too short a visit. We got to go talk copper. Dr. Copper, we've been talking with Dr. Lyngen of BMO Capital Markets. Absolutely brilliant.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
From Hanover, New Hampshire, Douglas Irwin joins us, professor of economics at Dartmouth. Paul, you had a brilliant insight there on where are we right now, Professor?
Well, it depends on whether we're talking about the U.S. or the rest of the world. You know, the rest of the world continues to trade, has not raised tariffs significantly. And I think what's hanging over the U.S. is we're in between two possible equilibria. One could be higher tariffs, Liberation Day tariffs take effect, or maybe taking effect August 1st, or this uncertainty. So we have tariffs about 10% or so. That's uncertainty about whether they're going to go higher and whether the deadlines will be extended or not. And they're both sort of bad equilibria. We don't want the high tariffs, but we also don't want to really live with this uncertainty about whether the tariffs that we have are going to be jumping up in coming months.
Professor, from your perspective, who pays the cost of tariffs? Do we know?
Actually, we do know, because we have these experiments from the first Trump term. And there's been about a half a dozen economics papers that have studied the issue, and it's domestic consumers. That is, the importers can't absorb those in their margins. They can't absorb the tariffs, so they pass them along. Now, that doesn't mean that final consumers, us as households, necessarily pay all the tariff, because there are various stages. And imported products sometimes are a small part of the final price that we pay. But there's no doubt that it's passed within this country. So it's not other countries paying the tariffs, it's we in the U.S. will be paying for these tariffs.
So in terms of tariff policy, I think most people have kind of understood it and experienced it on maybe a product by product or country by country basis. How effective are tariffs on kind of this kind of global approach that we're seeing from the Trump administration, and kind of what's the net effect?
Well, you're absolutely right that in the past, tariffs have been sort of piecemeal, either imposed on a particular product or a particular product coming from a particular country, anti-dumping duties, duties targeted at China and what have you. And so the easy thing about them, or one element of them, is that they're easily evaded. You just shift where you're importing from. It's called trade diversion. You start importing more from Mexico or Vietnam instead of China or what have you. But if you're imposing these blanket tariffs on everyone, it really has a much bigger effect than all those piecemeal tariffs that we've seen in the past.
Duggar, when I went back and I read the McKinley speech in Buffalo, New York, the day before President McKinley was assassinated, you've been eloquent on this. You said there was a shift in McKinley's certitude about tariffs. Can we see the same shift from President Trump?
I don't think we see it yet, but I think what you see is this conviction that we ought to be imposing these tariffs being tempered by some of his advisors, particularly Scott Bessent at Treasury. And I think the market reaction to the April 2nd announcement of the Liberation Day tariffs, that is 3 or 4 days of consecutive 1% declines in major equities, the rise in bond yields, that may have spooked the administration and may temper how much they're willing to follow through.
Your iconic book, Against the Tide, I mean, when you published that, the glacier was just pulling back north of Hanover, New Hampshire. If you move to the modern day, Doug Irwin, with a new financialization of American capitalism, can the financial vigilantes, the copper vigilantes, can they join Ed Yardeni's vigilantes?
In some sense, yes. I mean, the dramatic rise in copper prices yesterday, I mean, users are going to be paying a lot. This idea that, once again, other countries are going to pay the tariff, it won't be passed through to domestic prices. We saw that with copper just yesterday. And when we see this on shoes and T-shirts and electronics and all the other things that these broad tariffs may be applied on August 1st, we're going to have a major impact on the economy. And I think temper the ability of policymakers to say, yeah, we're going to go full speed ahead on this.
For all of you across the nation, a treat. Douglas Irwin of Dartmouth College. We continue. Paul Sweeney and Tom Keene. It is Bloomberg Surveillance. Paul?
Professor, some of the pushback on the tariff policies is centered on this concern that it may slow U.S. economic growth and it may push up inflation. How do you view those risks?
I think they're absolutely correct to be thinking in those terms. Once again, there's about a dozen different simulations and models out there, private sector, academia, think tanks, and what have you. And there's never a positive GDP impact from tariffs, and there's never a negative price effect of these tariffs. The question is the magnitudes. And of course, the magnitudes will depend a lot on what tariffs we actually see implemented. A lot of commentators say we don't see the data today. Well, we haven't really imposed a lot of the tariffs that have been proposed. We haven't imposed those that have been proposed. And so when we do, I think that's when we'll start seeing big effects on the data.
Discuss, Professor, the reciprocity. McKinley, in that famous speech before his tragic death, he mentioned reciprocity as a path to get out of onerous tariffs. If I look at Korea or Japan, the president's correct. They won't take our General Motors, our GM Cadillac Escalades or whatever. Tell me about reciprocity with Asia, Professor.
Sure. Well, the interesting thing about Korea is we have a free trade agreement with Korea. So the tariff that they apply on U.S. products is zero. So then you have to say, well, what's exactly the problem of selling in Korea? Are there non-tariff barriers? Are there other financial factors and capital flows that are driving the bilateral imbalance? And because that's what the administration is really focused on. They, with those reciprocal tariffs that they announced on Liberation Day, they said, well, we're just taxing them the way they tax us. Well, it wasn't that way at all in terms of the formula that they used. It's all based on the trade deficit that we have bilaterally. And once again, trade deficits don't really necessarily indicate trade barriers. We have trade surpluses and trade deficits with countries that we have free trade agreements with, where the tariffs are zero on both sides. We have a trade surplus with Australia. So those are very imperfect measures of what government policy with respect to trade are.
What is the best path or process for our central bank to deal with this tariff shock?
That's a great question, a very important one. I think the standard response is you sort of have to look through the price effects, but you can't look through the GDP effects.
Yeah, thank you.
So this is really why the Fed will be in a conundrum. If we see higher prices and lower growth, on one hand, you want to tighten to take care of the price impact. On the other hand, you want to loosen to take care of the GDP effect. I think it really depends on what sort of configuration of tariffs we see in August and coming months.
Brilliant. I can't say enough about that. That was a setup question, folks. I knew where Professor Irwin was going. And a major shout out to all the work of Jeffrey Frankel at a college. It's in Boston. It's on the Charles River. So it's one of those schools in Boston where Jeffrey Frankel said, don't forget GDP in the calculus of what central banks should and could and will do. Douglas Irwin is at Dartmouth.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
A little perspective. Chicago, long ago, was the bedrock of American isolationism. I lived it with my grandparents were entities out there a million years ago. And out of 1922, one organization in Chicago battled the inherent Midwest isolationism of America. It was sort of like Ike out in Kansas a million years ago. And that was the Chicago Council on Global Affairs. It is a sterling group. Michael Moskow, all sorts of great names of Midwest, William Daley, all sorts of names of Midwest business, Evo Dulder, as well as the chief executive officer. And they have scored a coup. It's like the Cubs getting middle relief in September.
Good.
Leslie Vinger Murray from London to Chicago, now President and Chief Executive Officer of Chicago Council of Global Affairs. Leslie, first of all, for all of Bloomberg, congratulations. What is it like to go from London and parachute into Chicago, Illinois?
You know, in today's world, it feels exciting. It feels normal in one sense. And thank you for that brilliant welcome and introduction. The Chicago Council on Global Affairs, you just nailed it. 1922, on the back of America's rejection of the Treaty of Versailles, of the League of Nations, and that group of men and women being very concerned about keeping America globally engaged. But, as you know, I was at Chatham House. Chatham House and the Chicago Council are both nonpartisan, independent, membership-based organizations in two really tremendously vibrant, dynamic cities with very large financial bases. So in that sense, it feels very familiar. Right. But Chicago, as you know, Tom, is a deeply, in the best of all possible ways, a deeply American city. And so I thought it was time to bring it home at a time when, as we know, America staying engaged is absolutely critical.
Two brilliant essays in the last 24 hours on the folly of seeking manufacturing renaissance in America. It's not there because of technology, whatever. You're now in the absolute heartbed of the hopes and dreams of manufacturing America. Can we create manufacturing jobs?
We can have manufacturing jobs. We should have some manufacturing jobs. We're clearly not going back to where we were. I don't think very many, if any, economists truly believe that. The demand for that is one that's intensely political. And not really very strategic or forward-looking or economic. We know the challenges of the future are going to be about automation, about artificial intelligence. We're actually going deep on quantum in a few weeks in Chicago. And so it's that looking forward and retraining and retooling and educating that are going to be essential. Unfortunately, we're stuck in a moment in the U.S. where the headline news and the kind of push by the administration is not really one that's tackling the challenges and the possibilities and potentials of the future. So I think those pieces that you're referring to are, the headline is right there.
Leslie, how would you, as we think about global affairs, global geopolitics, and we know President Trump favors the America First approach, how do you think this plays out in the coming weeks, months, couple of 3 years?
Look, President Trump came into office. We know he wanted to do those deals, to be the president who delivered peace, who really moved things forward, kept things calm. The campaign promises was the aspiration was things were quiet with me, they were calm with me. You got President Biden, you got all these wars. So far, that's been very hard to deliver on. And to be fair to President Trump, it was a tall mountain to climb to deliver peace in the Middle East, peace in Ukraine when Russia has really no interest right now in ending the war, and settling what is bound to be a very intense geopolitical rivalry with China for decades to come. Was always going to be difficult. So these are, very big challenges, and unsurprisingly, they remain largely unresolved. I think the best that we can hope for in Ukraine is that there is some effort by the U.S. And the West to sustain Ukraine's fight in that conflict, which is likely to go on for quite some time, and to get into a sort of landing position with China so that there is a steady diplomatic engagement and a dialing down of tensions. But this is extremely difficult. And now, and of course, in the Middle East, we have a situation where Iran appears to still have its nuclear capabilities, and the risk now, absent any negotiation, and that's, I think, where we should definitely try to head, is that Iran accelerates its desire to get a nuclear weapon.
A few years ago, you were at Council on Foreign Relations with Charles Kupchan on isolationism. Is the character of Trump isolationism changing from the rhetoric of the election? He's got a job now. He's dealing with Mr. Putin, as Paul mentioned, literally on a daily basis?
I think so.
So once a week phone call, something like that. Leslie, is it a new Trumpian isolationism that we're going to confront?
Tom, I've never seen President Trump as isolationist. I have seen him as certainly transactional, as being having a desire to work bilaterally and unilaterally, and not through multilateral venues. All of that is true, but he's deeply engaged in the world. He's very recently used military force against Iran. He's, as you said, talking to Putin. He's very ambitious globally. He's got a big personality, a big footprint. This is not an America that's retreating and ignoring the rest of the world.
Leslie, no one cares. All we care about, Cubs or White Sox. Can you get Pope Leo to show up so Chicago Council on Global Affairs can have an event at the new Comiskey Park?
It is a fabulous city, and I hope to go to all those games.
No clue.
Exciting to you.
Dr. Just remember, there's only one hockey team. Remember this name, Stan Mikita, and he's got a diner you can go to. I saw it in a movie once. Leslie Benjamin, thank you.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I have the clearest memories of Anne-Marie Horton from the Polish border at the beginning of the war, trying to explain the distance from the cities of Western Ukraine across to Kyiv into the battleground of Eastern Ukraine. We've covered, of course, the horror of destruction in the Black Sea. And within this, and the moment we're in right now, including President Trump's important comments yesterday, life goes on. We are thrilled to bring you now Alexander Komarov, who is a businessman, a simple businessman in Ukraine. It involves telecommunications. It involves his work out of Stockholm School of Economics. And we're just thrilled he could give us a brief this morning. Life goes on, sir, with great respect for the tragedy. What is the state of the economy in your Ukraine?
In general, it is okay. Taking into account the circumstances, I think that we are doing well. Of course, Ukrainian economy right now is around 80% in comparison to 2021 before the invasion, but it is growing. Okay, and with international support, we have demonstrated on average 4+% growth since 2022. Okay, and business is working, so all services are in place, critical services are in place. So I think the situation is quite okay, taking into account the full-scale invasion and war in Ukraine.
Away from your remit, and we've done this with Admiral Stavridis particularly, is the economy of the Ukraine Black Sea region. Is the grain exports there operable right now? Are you moving out your core export commodity across the Black Sea to the Mediterranean?
Yes, it is fully active. Okay, there are some limitations imposed by the war, but there is no blockade. and business is running quite well. Of course, it's not my area, let's say, of expertise. I am much more about digital business, telco infrastructure, and critical infrastructure. But what I see that we are able to export, so our agriculture, so overseas, without any kind of extra limitations. Yes, there are, let's say, war risks, but in general, it works quite well.
Alexander, your company, Kyivstar, is a leading telecommunications company there. I would think a reliable telecommunications systems will be critical, particularly for a country that is at war. What's the status of your telecom infrastructure today?
Across areas that are under Ukrainian control, we are fully operational. So we are running network almost like during the pre-war period. We are developing. We are investing into the infrastructure. Let me give you a few figures. In the beginning of the war, we built more than 3,000 new sites and actually more than 10,000 new base stations. So we are trying to ensure almost the whole population coverage with the modern technologies like LTE. So we already achieved 96%, and this is one of our focuses, is actually to provide reliable and redundant services to our customers. We are well prepared for the national blackouts. Right now, we can run our fixed and mobile networks up to 10 hours without electricity. And on the top of this kind of critical technical infrastructure, we are developing digital services and digital propositions to our clients. Right now, Kyivstar is not just a telco provider, it is a provider of the digital services with telco license based on the modern and the biggest and the most advanced infrastructure in the country.
So, Alexander, are you finding that your infrastructure is being targeted by the Russians and perhaps part of their strategy to disrupt communications?
Yes, of course. So since the beginning of the war, we lost around 3 core sites. So these are technological platforms allocated around Ukraine. But due to the mitigation efforts, due to a quite extensive, I will say, technical project, so we were able to sustain. And maybe you know that Kyivstar was targeted, and as a result of this cyber terrorism, so Kyivstar was the victim of one of the biggest cyber terrorism act in the global telecom world. But still, we are doing business, we are providing services, and we are demonstrating a very high level of resilience.
We would like you to come back on again, sir. This has been a wonderful brief on the realities. I've got so many more questions. Alexander Komarov, thank you so much. With Kyivstar, a cellular telephone operation, his tours of duty in Kazakhstan and Ukraine, I should say, have been just extraordinary. We'll have Mr. Komarov on again.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.